Welcome to The Explainer. Today, we're tearing down the latest quarterly report from Wells Fargo, one of the biggest banks in the U.S. We're going to skip the jargon and get right to what these numbers are telling us about the bank's health and its take on the economy.
All right, let's jump right in with the headline number. $5.59 billion. That is the pure profit Wells Fargo pocketed in just 3 months. But, a single number almost never tells you the whole story. So, how'd they get to that number? And more importantly, what's keeping them up at night?
To really get what's going on behind that big number, we're going to break it all down into 5 key areas. We'll start with the bottom line performance, then look at where the cash is coming from. After that, we'll dive into the risks they're dealing with, check out their financial safety net, and finally, see what their own crystal ball says about the future.
Okay, first up, the bottom line. Let's just get a quick snapshot of the bank's core performance with a few key stats.
So this slide kind of gives us the 3 most important vital signs. You've got the big profit number we just talked about. Then there's return on equity, or ROE, at almost 13%. That basically tells you how good the bank is at turning shareholders' money into more money. And finally, you have the efficiency ratio. Think of this as a bank's golf score. Lower is always better. At 64.9%, it means for every dollar they made, they had to spend about 65 cents to run the business.
So we know how much money they made, but where exactly did it all come from? It's time to pop the hood and take a look at the bank's actual business engine.
And this chart breaks it down perfectly. You can see right away the biggest piece of the pie. At 45% is consumer banking. That's the part of the bank most of us interact with. Checking accounts, credit cards, mortgages. Now, relying this much on the everyday person is kind of a double-edged sword. Sure, it's a steady stream of income, but it also means the bank is really exposed if the economy starts to slow down and squeeze people's budgets.
And this slide really gives you the full picture. It's this massive machine that's involved in everything from your neighbor's mortgage on Main Street, all the way to huge corporate deals on Wall Street, and of course, managing fortunes for wealthy clients. This diversification is absolutely key to their whole strategy. If one area is having a tough time, the others can hopefully pick up the slack.
Now, banking isn't just about making money, right? It's really about managing risk. Every single dollar they lend out comes with the chance it might not come back. So let's take a look at the economic headwinds Wells Fargo is getting ready for.
The biggest, oldest, most fundamental risk for any bank is what's called credit risk. Put really simply, it's just the chance that people or companies won't be able to pay back their loans. So how's the bank keeping an eye on this?
Well, they track something called non-performing loans. These are basically the loans that are in the danger zone, the ones that are at risk of not being paid back. And this table shows a total of $7.9 billion in these problem loans. You can see that's up a bit since the end of last year. It's not some huge dramatic jump, but it is a clear sign that a little more financial stress is starting to creep into the system for both businesses and consumers.
And then there's the other giant risk, interest rate risk. See, banks make their money on the spread. The difference between the low interest they pay you on your savings and the higher interest they charge on loans. When those market rates start swinging all over the place, that profit margin can get squeezed, or it can get a lot bigger.
And this is where it gets really interesting. This slide shows just how sensitive the bank is to those swings. Their own models say a 1% hike in rates over the next year would add $1.4 billion to their income. Nice. But a 1% cut in rates would actually cost them $1.8 billion. That difference tells you they're set up to lose more if rates fall than they'd gain if rates rise.
So given all these credit and interest rate risks, you have to be wondering, just how prepared is this bank for a real economic storm? Well, that brings us to its financial cushion.
The easiest way to think about this is like your own personal emergency fund. For a bank, that fund is called capital, and regulators have super strict rules about how big it has to be, just in case things go really, really wrong.
The gold standard for measuring this emergency fund is the CET1 capital ratio, which is what you're seeing on this chart. Regulators say Wells Fargo has to keep this number above 8.5%. As you can see, they're currently at almost 11%, which gives them a pretty solid buffer over that required minimum.
And that surplus is everything. It's not just some extra money lying around. It's designed to be a critical shock absorber. It's there to soak up huge, unexpected losses, say from a deep recession, and keep the entire bank from becoming unstable.
All right, last but definitely not least, let's look to the future. Banks don't just sit around and react to what's happening. They're constantly trying to predict what's coming next. So, what does Wells Fargo see on the horizon?
To get ready for those credit risks we talked about, the bank has to set aside this giant pile of money called the allowance for credit losses. And how much they set aside isn't just a guess. It's all based on these complex models that weigh different possible futures for the economy, from best case to worst case scenarios.
And this slide shows us the blended forecast Wells Fargo is actually using to plan its business. And wow, they expect the unemployment rate to climb pretty significantly, hitting 5.6% by the end of 2026. They're forecasting a short economic contraction, with GDP actually shrinking by 1%. And they see a deep, continued drop in commercial real estate prices. So let's just be crystal clear about what this all means. The bank's own internal models, the ones that decide how much money it needs to save for a rainy day, are painting a pretty gloomy picture of a slowing economy. They are actively getting ready for tougher times ahead.
And that leaves us with the big final question, doesn't it? This report is a snapshot in time, but the bank's own forecast is telling us the whole economic environment is about to change. How they decide to adapt their strategies for risk, for lending, and for their own efficiency in response to the slowdown they see coming, well, that's going to be the next chapter in this story.